without further delay, I think I'll hand over to Chris. We've just recently launched our Q2 quarterly perspectives publication. So Chris and John are just going to talk through that, give our current view on the world. And I've got a few questions that have come in over the course of the last few days on the back of previous presentations. So we'll have time to ask those at the end, hopefully. Chris, John, over to yourselves.
Okay, well, maybe I'll just start off by just welcoming everyone to the call. You know, John is in London, I'm in Portugal. Not much has changed on that regard for the last couple of weeks or last month. The team is working as normal, and as you can see, we put together a new publication, the Q2 quarterly perspectives, where we outline what worked well, what didn't work well in the last quarter, and how we're currently positioned. You know, if I look to page 1, you know, the thing that is quite striking is that we made quite a few changes in the last quarter, and our views of asset classes have really moved markedly. It's probably the most active trading quarter for market-related reasons that we've ever had. And that's really because we continue to defensively streamline all of the portfolios so that we have liquidity if and when we need it, you know, whilst remaining fully invested. The portfolios, the multi-asset portfolios are fully invested. We're running cash levels of around anywhere between 3 and 6%. So we're not out of the market, we're in the market. And what we're looking for is the markets themselves to act defensively together, to defend capital, but also, you know, continue to benefit if, as we expect, there'll be a recovery. There has been a substantial recovery from the lows set on the 23rd of March. Markets have rallied. Quite a few markets are now technically in bull market territory, you know, having rebounded more than 20%. But, you know, just as an overview of our asset allocation outlook, you can see that we really haven't done much to our global government bond positions. We're marginally underweight duration. What we did was we increased significantly our exposure to global investment grade bonds because most G10, I suppose, central banks are including investment grade bonds in their quantitative easing programs. So even though we find bond markets to intrinsically have very little value, they're negative yielding after inflation, the fact that central banks will continue to support the market to bring down longer term rates means for the time being, we're going to continue to have exposure there. We paired our high yield position vis-a-vis the benchmark. Reason being, we saw back in 2008 and 2009, a real disjointed market, lack of liquidity, and the situation is worse today. The one thing that has changed in the last couple of weeks is that the U.S. Federal Reserve has said that it will buy a sector of the U.S. high yield market called fallen angels, which we've had a position in and out of over the last several years. That's really all companies that were issued as investment grade and then subsequently downgraded. That doesn't make the sector any more liquid, nor does it make the companies that were being downgraded any more investable. But there was an initial surge in interest in the fallen angels ETF, which is subsequently corrected, and it's now lower than it was at the time of the announcement. And you can see in emerging markets, again, for very much the same reason as high yield, we pared back our exposure both in local currency and in hard currency. We're concerned that there are a number of emerging markets that will have US dollar primarily denominated bonds payable, and there'll be a shortage of dollars in the market. So for the time being, we're running underweight high yield and emerging market bonds, but overweight investment grade. In equity land, you know, we're actually, I'll let John take over and go through our equity positioning over the quarter and what we like going forward. John?
Can you hear me?
Yep, go ahead.
Cool. Okay, so just sticking to the high level asset allocation chart, our preferred areas are the US and Asia Pacific equities. We think this for two reasons. Firstly, within East Asia, we've seen remarkable resilience from China and from South Korea, who in China, that's where the virus originated, and due to their method of government, as well as the ability to implement various mobile phone applications, they seem to have been able to contain and control the virus quite well. And it's a similar story in South Korea. So that's the roadmap. We don't see that changing at the moment, although we continue to watch carefully because the validity of the data can be questioned. But as a result of that, the economy has held up very well. We're seeing factories go back to work. We're seeing coal consumption picking up. We're seeing property sales picking up. And actually, we're seeing that represented in financial markets. They've proved remarkably resilient. So as a result of that, we have an overweight allocation to the Eastern Asian region. And actually, as a subset of that, and we'll move on to the slides later, we also put on a trade a little while ago now, which was rotating from oil producers to oil importers, on the basis that a lower oil price would benefit those countries and economies disproportionately. That's proved a remarkably salient, quite timely move, given what happened in markets yesterday, particularly yesterday evening. So I don't know to what extent all of you follow markets on a hour-to-hour or day-to-day basis, but just as a quick recap, we saw oil prices fall dramatically, and at the short end of the curve, because oil is traded with delivery dates, we even saw oil prices reach zero and cross and move into negative territory, meaning those companies that produce oil were paying people effectively to take it off their hands. And I'm happy to get into that into a bit more detail later if anyone has any questions on it. But the point remains that that trade seems to have worked quite well, and hopefully will continue to do quite well within the Asia Pacific region. And then just quickly on the US, we increased our US equity allocation to more attractive. We did that at the same time as the US was embarking on this this 2-week period where things were going to get a bit rough and tough. Donald Trump referred to that in one of his tweets. But the point remains that compared to other developed market countries, notably Europe, which quite frankly is a bit of a mess in terms of the political response to the crisis, the US is quite well placed, quite resilient, and quite well placed to hold up against it. So as a result of that, we continue to like US equities, not necessarily generic US equities. The area in particular that we think has done well and can continue to do well is the healthcare sector, and that is a position that we have rotated into over the last period.
And also, I should also just say within the US, we have an overweight position to technology, because we think that's a sector that will continue to outperform, especially in the areas where effectively remote working. There's an awful lot of companies that operate in that space, and the consistent theme across all of our equity rejigs is we're looking to go up the quality curve, to have more exposure to companies that have either cash generative or have higher cash balances or low debt levels of debt. So the whole idea is that even though we're running, pretty much fully invested, we're trying to have exposure to the part of the global equity market that will win out of the current economic cycle. So anyway, back to John.
Okay, what would you like me to talk about? A bit more on the equities?
Well, let's just keep moving through. Let's maybe go commodities, and just our position. And I think dwelling on ESG might be good as well.
Okay, perfect. So moving on to the alternative space, we have two categories in the table. One is commodities, and the other is property equities. Commodities is a broad church. There's precious metals, industrial metals, agriculture. It's very difficult to make a sweeping statement on what you think commodities in general are going to do. However, we're going through a period where investors are really starting to question the motivations of central banks. the role of the central bank traditionally has been to maintain a degree of price stability. They have inflation targeting and employment objectives. Whilst it's not an official objective, the US Fed also, as the leader within the global economy and the owner of the global reserve currency, which is the dollar, also has a degree of responsibility to the rest of the world. And that plays into the huge stimulus measures that we saw coming through and efforts to bring the value of the US dollar down. Within commodities, we have a position in physical gold. The reason we have a position in physical gold isn't so much as a hedge against inflation. It's more a hedge against the fact that the credibility of central banks are being eroded. The Fed is now almost doing exactly what Donald Trump is asking them to do. And that essentially is to increase the amount of money in the global economy to ensure that families, individuals, and corporations have access to cash. And they need access to cash because if they don't, they might default on their debts. And that turns what at the moment remains to be, an issue regarding the virus into something that could turn a lot nastier, i.e., a proper liquidity crunch and a proper financial crisis. So the Fed is buying time, pumping money out there to keep everyone afloat, floating on the water on this wave of liquidity to keep everyone going. Now, I put out an email on Friday, and it's going to go out as a blog later this week. But as a consequence of that, there's a chance that over the longer term, the dollar may well start to depreciate in value. In fact, a lot of developed market currencies may well depreciate in value. And one instrument that could do well in that scenario over the longer term is gold. Over the shorter term, we have physical gold rather than synthetic gold or access to gold via financial instruments, via futures, because it's a real asset. If things get worse, you want to be able to say, I own this, and this has real value in the world, and gold does. So within the commodity space, that's where we have our allocation. We have it to physical gold, and it's doing well. It's doing its job. It's holding up it's holding up in value in the portfolios. It's outperforming the broader commodity complex, and we see further upside in that space. Property is an interesting one. Longer term, kind of like property. We have I'll just talk generically about in the UK perhaps, because that might be of most interest to the majority of advisors. We had the Boris bounce after the election because we had people kind of backing off and thinking, well, the probability of a hard Brexit has diminished considerably. For the last 2 to 3 years, households were putting off decisions to step into the property market for fear of what might happen in the case of a hard Brexit. All of that unwound, and we actually had a huge increase in interest for properties. Viewings per house went through the roof, and the property market bounced in a very short space of time by a considerable margin. However, it comes back to this issue of liquidity. It comes back to this issue of cash is king. And the property sector is quite difficult in a way because it's remarkably, it's quite illiquid as a sector. We've seen some property funds kind of closing up to protect themselves from investors removing their money. So now's not really the right time to start getting involved in property. It's a similar view to what we have regarding mortgage-backed securities, actually. So we've taken that down to slightly underweight. We no longer have any positions in property. We did have a position in the US property yield because it delivered a nice, attractive yield, but we removed that 2 to 3 weeks ago. And we're happy to sit on the sidelines for the time being. And then quickly, I'll finish off with ESG. We've put out a lot of documentation over the last, actually since the launch of the ESG protection portfolio, which details the benefits of ESG and the increasing interest amongst the investor community in how ESG can add value to portfolios. We like ESG. We continue to have an overweight view on ESG. ESG, I personally view it as a factor. The factor it's most similar to is quality, because if you're scoring high on ESG, i.e., you're doing the right thing by the environment from a societal perspective, and in terms of good corporate governance, then you're a quality firm. And quality means high cash balances, good quality of revenue. You're not distressed. You're not on the junk end of things. you're at the top end of that credit spectrum within the equity or fixed income space. So we continue to like ESG, and as a structural strategic position, you want to rotate your investments towards quality assets, and top of the quality pile is ESG.
Yeah, and just on that point, we have rotated all of the. We have more ESG. We have more ETFs to score high on the ESG charts throughout the whole proposition. Not that they are anywhere near as ESG compliant as the protection portfolio, but they, just as John says, they score very well on the quality curve, which means in an environment where we're trying to defensively streamline portfolios, these are good go-to holdings. And there's a chart toward the back that James put together, looking at how ESG has performed during the first, I think it's either first quarter or the last 12 months, which demonstrates how ESG investments have outperformed their peer group over the time period. It's maybe 1 year. We'll get to that later on. Just very quickly, I'll finish up on FX. John's already alluded to it. We haven't really changed our view on anything in the last quarter other than the euro. The collective European response to the virus has been woeful. It seems to be every country for themselves. The head of the ECB, the head of the EU have been remarkably ineffective, and they appear to be directionless. And Europe always says, well, we get there in the end, but the damage that's being done all over Europe, especially in Southern Europe, is quite remarkable. So to think that there's still a view in Northern Europe that we won't subscribe to a pan-European global finance facility or Eurobond or coronavirus bond to fund everyone out of this mess is quite extraordinary. I personally think that we're in the early stages of the demise of the Eurozone as we see it. And in actual fact, you're starting to see some of that through sterling, because effectively sterling, the UK's had a hard Brexit. Supply chains are broken today because there's no trade going on, and it's not impacting the UK. So the odds of a harder Brexit, in my opinion, are on the cards, because politicians in the UK are realizing, well, we're now worse off. So I can see when we come out of quarantine that the UK's position at the negotiating table is going to be very, very tough, because ultimately, given the trade flow, the EU needs the UK more than the UK needs the EU. So I think that game will start to be played as we get into third and fourth quarters. All right, let's just go forward to a couple more slides. John, over to you. You want to do?
Yeah, sure. Thank you very much. So what slide are we on now? We're on the, okay, perfect. So the nature of this crisis is very different from what we've seen before. It's quite unlike the corporate overinvestment of the late 90s, .com, the subprime mortgage crisis. This crisis has materialized out of a political decision to shut down the economy, to save lives, and to ensure that the burden on the NHS is spread out over time. And as a result of that, we've had a very, very quick, very deep impact on a whole range of economic indicators, notably employment, as well as personal consumption. What we've seen, interestingly, is those businesses that are typically quite resilient during a recession are struggling, and those businesses that typically perform poorly during a recession are doing terrible, like airline companies, cruises, aircraft manufacturers, etc. And it all comes down to this issue of shortfall in revenues, cash and cash burn. But having said that, we're tempted to kind of look. The numbers almost don't mean anything anymore. Every day you look at a new metric, and setting aside the impact on people's individual lives and personal lives, which of course is can be in some cases tragic and is important. From an economic perspective, they almost don't mean anything anymore. A lot of investors are no longer care really how many more people are becoming unemployed, or just how bad the earnings numbers are going to be, because we know they're going to be bad. Markets in general discount what's going to happen over the next 6 months, to a year. And if you look through the numbers, what does the recovery look like? Is it a V-shaped recovery? Is it a U-shaped recovery? I hate the VUW thing, but they do a good description of describing how we're going to bounce back, and that's exactly what this chart does. So for me, it comes down to two questions. The first is the duration of the virus, and the second is what institutions are doing to resolve the virus. This chart kind of relates to both, but I'm going to focus on the first question, which is the duration of the virus. And the reason we think the virus duration could be short, and obviously we're not virologists, is because the lockdowns appear to be working. So we're actually seeing notable improvements in Europe, in the US, in Austria. They're opening businesses again. In Germany, they're opening businesses. The Mercedes-Benz and BMW kind of dealerships are kind of they're slowly coming back online, which is big in Germany. We're seeing schools starting to open in Denmark. So what we're seeing is improvement, and we're seeing a similar progression as what we saw in China and South Korea, which as we've communicated previously, we continue to use as the roadmap. So if the duration of the virus is short, it comes down to how we go about relaxing restrictions to ensure we don't get hit by a second wave. It seems like good now, but if we all suddenly start going back to work again, is it all going to spike, and are we going to end up back where we were before? The virus isn't going to go away. So it's this trade-off between economic necessity and how you handle it from a societal perspective. And here there's a roadmap too. Factories will come back first, where distance working is possible, followed by shops, and then offices where you have team structures, team A, team B. International travel is probably going to remain limited, and if you do travel, you're going to have to go through some kind of quarantine process on the other side. Conferences and large social events will continue to be on hold, but there is a roadmap, and I think in the East it's already a societal norm to wear face masks. It's less so here, but increasingly as we go back to work, I think we're going to see more people wearing facial masks just to ensure we don't have this second wave. And if that comes through, then what we could see is a rebound similar to that which you see in the chart. And the chart represents the G8, some of the largest economies in the world, and it shows a very steep and very drastic drop in real GDP year on year, and then it shows a bounce back. And whether or not this comes true, I don't know, but we are looking through the numbers, and we do believe it will come back online. We are optimists, and part of that is also a function of on a vaccine. We're seeing some positive. I mean, there's a large number of vaccines that are being worked on as we currently speak. Last week, there was a vaccine linked to Gilead Science. You can't read too much into it, but it was very positive, and the stock price jumped 11% in the aftermarket. So let's not get ahead of ourselves. But my final words will be: don't underestimate human ingenuity. And we're at risk of maybe underplaying that. But if you take a positive view, then you're more likely than not to stay invested, to participate in the recovery that we've already seen in equity markets. The S&P 500 has bounced back 50% and is kind of at a level now where it's like, what's it going to do next? And be positive, and that's what this chart shows.
Yeah, and just on that, the S&P 500 retraced 50% of its losses. It's up. So it hasn't risen 50%. It's just retraced a good chunk, over half of its losses. This next chart, thank you, John, to infinity and beyond. This just shows what the U.S. Federal Reserve balance sheet is projected to balloon to. The famous words of "Don't fight the Fed." They have committed unlimited resources and liquidity to the U.S. economy, in conjunction with the government's fiscal initiatives, which now tally, I think the better part of $6 trillion. What this is the monetization of effectively debt, because at the moment, the U.S. Fed is buying bonds in the secondary market I can see almost the next step is they're going to be buying them from the federal government themselves, which is dangerous long term because it effectively means they're monetizing the debt, and down the road it could lead to inflation. In fact, it could lead to hyperinflation. But I think the initial reaction in markets is for a period of low inflation or deflation. But I think if you look, we're looking at in longer term inflation forecasts or inflation expectations, and the larger this balance sheet grows, the likelihood of hyperinflation increases. So again, hyperinflation really bad for conventional bonds, but good for index-linked bonds. So we already have a position in the U.S. market, and we don't have one in Europe, mainly because the Europeans haven't really got to this state. But I can see in time they will. Moving along, this is John's chart, which maybe you've seen before, but John, why don't you go through this one?
Yeah, I love this chart. If you're invested over the long run, then you want to be in equities. And this upward trend has existed since the 1950s on this particular chart. What I particularly like about it is the fact that during this whole period, we've had a huge financial crisis, notably 2007, 2008, although we've had other crises as well. And you also had a big oil shock in 1973, 1974. So I like that because what are we living through now? We're living through a crisis. What are we living through now? We're living through an oil shock, not necessarily to the upside, to the downside. And despite that, we're still in this channel. So, a lot of people get worried because you're living through a crisis. This time it's different. Maybe this time we need to worry about it. Well, look at history. It's very unlikely that this time it's different. And what we saw was a bounce off the bottom of the trend line. And so the long-term outlook remains positive.
Yeah, and on this, everyone's very well aware of Warren Buffett, and everyone's saying the sage of Omaha is one of the best investors who's ever lived. Well, quite simply, this is his life, and what he does very well is he squirrels away cash when we have a hefty correction, which we're going through now. That's when he goes long, and you can see the sage of Omaha, his career is going throughout most of this uptrend, and it's no wonder he's considered one of the best investors of all time. So quite simply, he never fights the bull. He is always invested, and when markets trade lower, he increases his position. And I think this is well worth remembering when we look at certainly clients who are younger, quite a way away from retirement. The rationale to be long a diversified portfolio of global equities is this chart in essence. Closer to retirement, it's another ball game altogether. Chinese bonds, we've alluded to this before in the past, how well Asian economies are doing when compared to their Western counterparts. The white line is the Chinese government bank bond index, Treasury and bank bond index, versus the global aggregate, which is in red, and then the EM local currency in green. So we started to build a position in Chinese government bonds, I would say 9 months ago, something like that, where we were index neutral. Now we are actually long the index. The Chinese central bank, the PBOC, has done I think a very measured job at providing liquidity when it's required, especially over the last 12 weeks during the virus. And you can see the return in the domestic market, bond market, is a sea of tranquility. So we've been a buyer of Chinese government bonds, and they've worked well within the portfolio.
There's also a nice narrative around that, which is kind of towards the end of last year, investors were worried about the huge increase in supply of Chinese bonds that was going to come onto the market, and that would be negative for Chinese bonds. But actually, since then, and given the coronavirus and the huge stimulus, and which requires issuing bonds in the US, we're talking like 10-15% of GDP. All of a sudden, that increase in supply of bonds in China, it doesn't matter anymore. That relative argument has kind of disappeared. And in the background, there's always this: the major indices are slowly including Chinese bonds into their benchmarks. So there's kind of like the narrative on this has changed quite nicely over the last few months, and yeah, we've benefited from it. Yeah.
All right. Well, this is the trade that the famous saying, "Don't fight the Fed." This just shows the inflow into investment grade credit in the U.S. Following the Fed's decision to buy or to pledge unlimited liquidity in the secondary market in investment grade securities. So we've always had a large position in investment grade, but during March we've increased it, and that's a position that we're very comfortable holding because at the time being, the biggest buyer on the planet is in the market every day buying tens and tens of billions worth of securities. Asia, John, do you want to now into Asian equities?
Yep, Asian equities. So this chart shows the Indonesian stock exchange, Jakarta, and the South Korean stock exchange on the right-hand side. And the data runs up to the 6th of April. What it shows really is, some emerging markets suffered a little bit, particularly during the period where everyone was trying to get their hands on the US dollars. And it was before the Fed stepped in and said, we'll open FX swap lines, we'll open repo facilities. And as a result of that, money did flow out of emerging markets. And that's the story at the beginning of the chart. But this is a positive story because we took positions in these markets as a result of the rotation from oil producing companies like Mexico and areas of Latin America to oil importing countries, which include these two, as well as China. And from the 23rd of March, which was the market bottom, the point at which we started to bounce, these two markets led the way. They were the first to break into bull market territory, which is defined as a move of 20% or more. And on the chart, the yellow scaling shows 23% on the way back up again. So it's we're kind of happy with how that trade's played out. We want it to do better still. The South Korea benefits because it's dealing with the coronavirus particularly well as benefiting from low oil prices. In Indonesia, it's a slightly different story. They're less effective at handling the coronavirus, but they still stand to benefit from oil. So there's a bit more of a trade-off there. But this is the main point from this slide is we like certain Eastern Asian countries, and that's how we're positioned in the portfolios.
I mean, the theme to tilt east or pivot east has worked very well for us because those are the countries that seem to have weathered the virus storm better. The part of the world that is suffered the most is in Europe, and they're handling the virus, the worst of all the developed world. So we're really kind of have a big East and U.S. barbell trade on within our equity exposure because that's where we see higher quality and better government responses to the virus, at least to date. Smart Beta, this is just a report card to see how things have been doing. I think most people should be aware that within our developed market equity bucket, we have a Smart Beta plug, which is a combination of the 5-factor tilt model, which is what you've got here, and you can see that stocks that exhibit higher scores on the momentum scale or min-vol or quality have outperformed the MSCI World, the mothership index, whereas value and size have underperformed. So at the moment we do not have any size. We've got virtually little value to my knowledge, but quality, min-vol, and momentum is where we have been positioned for the last quarter or so, and that's added value to the portfolio. vis-a-vis having just an outright position in the MSCI World, which is our developed market equity benchmark. So the smart beta tilt has worked very well this year in particular, and long may it continue. Commodities, Don?
Yep, so this chart is kind of self-explanatory, really. The broader Bloomberg Commodity Index in green has been drifting lower as the global economy slows. There's less demand for certain materials, and then there are the two kind of notable outliers, one to the upside and one to the downside. So the spot gold price is in white. It's providing excellent diversification benefits to the portfolio and a counterweight during the sell-off that we had. One thing that's quite interesting about the white line, if you can see it, is kind of from around March 09 to just after March 16, you can see it falls at the same time as the green and the orange line were falling. That was kind of interesting because that was the point where people needed dollars so much that they were almost willing to sell anything and everything, including traditional safe havens like US Treasuries and, of course, gold. But when the Fed stepped in and resolved it, we quickly saw that came to an end, and then it consolidated and continued to perform well. So it's acted as an excellent counterweight in the portfolios, and it's done exactly what we wanted it to do. It's just worth mentioning, prior to our switch into physical gold, we had an allocation to gold producers. That is to say, companies that operate within the gold mining sector in the exploration and production of gold. We decided to gold producers typically acts as a high beta, or rather an amplified version of what happens in the underlying gold market. But we decided to rotate out of that and into physical gold, because you can't beat real physical assets, particularly during periods of stress. And the gold mining sector comes with a whole range of idiosyncratic risks and factors, as well as a lot of them are going to come under issues regarding their debt levels and access to cash. So it was a prudent move, consistent with our theme that the return of capital is as important as the return on capital. And then moving on to what's probably a little more topical, given what happened yesterday. The orange line shows the price of oil. So coinciding with the coronavirus crisis, we also had a bit of a spat, or an apparent spat, although actually Chris and I think that behind the scenes it's not necessarily what it seems, between Russia and Saudi Arabia. And instead of conducting an orchestrated cut as part of OPEC and OPEC Plus, to cut production, because people demand less oil. So you need to supply less oil, otherwise there's going to be an imbalance between the two and oil prices are going to fall. Well, in an attempt to grab market share and to potentially drive US oil companies, particularly in the shale Permian Basin, out of business, they kind of ramped up production. And that can be seen by the fact that oil prices have fallen quite a lot. In fact, they're pumping out so much oil that the storage, they're almost reaching capacity in terms of storing oil. And that's interesting, because now it's a point where if you're buying oil and you want to take delivery of it, where do you store it? Where do you store that oil? And if storage is at a premium, it's going to cost you more money to store that oil. So it got to a point last night where, and I feel sorry for those traders that did this, it was like, well, oil was like $1 a barrel at one point. Well, this is a bargain, I'll snap it up. But if you do, like, you're going to have to take delivery of it, because the oil price continued to fall to a point where it was negative $40. And it's kind of a technical factor, because today's the last day where you buy oil for delivery in May. Otherwise, you do it for June. So it's kind of a technical issue, but it's super interesting, and it's never happened before in history. And one of the conversations that we had this morning as an investment team on our Google Hangout chat is who benefits from that. And the jury is still out, but one of the countries that still has storage, B strategically is willing to buy up a lot of oil at a very, very low price, historically incredibly low, is China. And actually, China remains one of those countries that also has the ability, given the huge amount of steel and other commodities it buys from Australia and other countries, to build relatively quickly more storage facilities. It's just not really possible elsewhere. So we've talked previously about liking Chinese equities. Well, we have to see how this plays out, but the oil story might be an additional boon to China as well.
All right, excellent. Thank you, John. Dash for cash. Well, this is an interesting one. I think on the call last time we alluded to what's going on in sterling, which sterling dollar. You can see this is the red line. We're seeing some odd price action in markets. As John just described, the sell-off in the May West Texas International crude contract collapsed. Here, this is sterling dollar. This coincided with a spike in volatility, FX volatility, which is the white line, and this was in March. So sterling dollar started the month about 130, traded all the way down to about 114, and then closed the month. Exactly sure how accurate maybe it doesn't go all the way to the bottom, but it closed the month at around 123, 124, but on thin air. There was no economic number that justified the massive collapse, and then it's bounced all the way back, as you can see. It's now about 125. But this is what we're starting to see in certain credit markets, in the FX market, and this is why one of the main reasons why we run a discretionary partial currency hedge across the proposition to immunize investors from this type of unexplained movements. We don't run anywhere near a full hedge. It runs at around 60 to 70%, and we do it on a fully discretionary basis based on where we think fair value is for sterling. But this was a good example of why we do run a currency overlay, because for conservative investors, you don't expect to see a 14% fall in something that is not particularly a direct play within a bond portfolio. So we are getting strange price movements in markets, which is why, I'll say it for the last time, defensively streamlined our portfolios. We're trying to make sure that we never get caught in anything like this. That's absolutely essential. And that's why we have, in my opinion, very clean, liquid, agile portfolios, which is where they'll stay until we start to see some normalcy creep back into markets. Let's go on to John. Do you want to do the ESG report card?
Yeah. So this chart represents the returns of ESG investments versus non-ESG. So kind of like the ESG within the UK equity space versus generic UK equities is the example for the top one. And actually, it's not just ESG, which stands for environmental, social, and corporate governance standards. It's not just ESG; it's the best of the ESG, which is called SRI, socially responsible investments. And what we found is, as we've been saying, quality has been performing well, and it's been outperforming more traditional market cap weighted investments. And that's exactly what we've seen play out here. We've seen that the ESG investments have outperformed the traditional investments, and actually by quite a considerable margin. So this shows the performance from the end of December 2019 to the end of the first quarter, and the numbers are represented in basis points. So 588 means 5.88%. So that's quite considerable. And what we're seeing is that across the equity complex within UK, European, Japan, US, China, world, the red bars are largest in those instances. Now, the broader point to be made about this chart is that ESG scoring, the ability to look at the companies within the products that say, hey, we're ESG, is better. It's easier to score those companies in the equity space. It's a bit more difficult to do it in fixed income, simply because simply because it's still relatively early days. More ground needs to be made up within that area, and it's also a little bit more difficult within emerging markets where the quality of earnings and also the reporting standards are a little less effective. So in other words, you can take it with a bit more of a pinch of salt. So as a result of that, we're seeing kind of better returns in high yield and investment grade bonds, but only marginally so. And within the emerging market space, there's no discernible difference. But that doesn't mean that those companies in emerging markets or within the fixed income sphere aren't delivering better returns. It's just more difficult to capture and quantify who the good guys are versus the bad guys, and for that to feed through into the chart. But it's a very powerful chart regarding investing in ESG.
So aside from our typo on emerging market and sovereign debt, sorry about that. I just noticed we have a typo there. Right, thanks, John.
Hey, that wasn't my typo. I'll take it.
I don't know. I don't think it was in the main deck. So, but anyway, right. I think this might be our last slide. This is just kind of where we think further out, and my view is that with interest rates as low as they are, debt issuance as high as it is, government deficits about to go sky high. We're going to an environment halfway to where we were coming out of the Second World War, where bond markets yields rose for 30 years. It's going to be a hard slog to make money in fixed income, corporates or governments, on a forward-looking basis, given where rates are, because eventually the central banks will have to trade out of their positions. So this is where we think the majority of money will be made in investor portfolios over the next decade. I'm not saying the next six months, but in the next decade. If we look at the last 4 recessions, for the 2-year period following the end of the recession, you've seen the MSCI World Equity Index or the Goldman Sachs Commodity Index on average make around 20%. That is where we want to get positioned towards. We want to, at some point, we want to be long an oil trade. Why? Because the price of oil isn't at zero, because the new front contract, which is the June contract, is trading around $21, West Texas International. So, but that's where, the forward price of oil is going back up to $30, $40 a barrel. This is where we think we are going to be making our returns, when we come out of this recession, especially in equities. I don't think we haven't broken out of the 70-year bull market in the S&P 500, and given we've had such a big correction, we've had a relief rally. The reality that's sitting in now means we may go down and test the lows. I really don't know, but we've got liquidity to trade, to come out of the market if we need to, but also re-engage very quickly. But I think portfolios are going to generate returns for investors over the coming, the typical investment horizon of 5 to 10 years. This is the chart that tells me this is where the money's to be made. So we're not positioning the portfolios here today, but we want to have one leg already in this trade before it moves too far away from us. So this is how I think, when I look at the world today, I think the numbers, as John alluded to earlier, the economic numbers are going to be dire for the second quarter. We're just seeing first quarter numbers. The earnings will be dreadful in second quarter, but also markets are forward looking. So we're going to get immune to the negativity. For what it's worth, I've stopped watching the BBC, the ITV, and Sky News. I turned them off because it's just overwhelmingly depressing. And I would encourage everyone else to do the same thing. Read a book, stay inside, social distance. But the press is in overload on negativity. But in reality, looking at how equity markets are trading, professional investors are looking beyond the doom and gloom in thinking, okay, where do we want to be positioned when we come out of this? Because you either take the view we're never going to come out, which means there's no point worrying about it, or if you think we're going to come out, let's be sure we benefit to the upside, and that's where I think that the entire proposition is positioned as of today. We think we will capture a good chunk of the upside when it comes, without knowing when it will come. We're very wary of bond markets, primarily from a liquidity standpoint, current, at the moment, because it's not very liquid. And yeah, that's probably enough for me, because I know Steve has some questions. I think that's the last slide. Yeah, that's it.